Implied volatility. There's lots of things around this subject. I want to focus in on the spreads. What do I mean by that? Well, with low implied volatility, the spreads tend to be a little bit tighter together, closer. With high volatility, they'll make the spreads wider or bigger. And because of that, it makes the ROIs different and the break-evens different. With implied volatility being 1/3 of the option value price, whether going up or down, dictating what happens to our options cost, we want to know more about it. So when looking at something like Apple and you see it coming into resistance, but having a relatively low IV at around 0.3, it's not like the other times around earnings when the IV was higher and then sold off, and that would have collected the premium, adding value to you. So when we look at Apple vertical spreads, calls September, and we look at the spread right at the money, we see the bid is 270 and the ask is 285, meaning it's about 15 cents apart compared to DRNA up against resistance, and implied volatility has moved in a range of 0.2 to 1.4, which you can see that whipsaw effect created about 100% increase. As it came down off of those highs, it dropped over 45%. So looking at Apple with low volatility, we see that there's a 15-cent spread between the bid and ask. Versus DRNA, the bid is negative 250, the ask is $7.20. That's a $9 spread when the other is only 15 cents. This is what high implied volatility does. It whipsaws. DRNA has not really moved too much in price, just kind of sideways. And that's what's so strange about this spike. When looking at HCM, we put in a call right here, and you can see implied volatility was really high at 1.00. You can see here that price went up against us, but implied volatility fell off, adding value to our options. But right now, we're really equal at the value that we got into the trade. So we are collecting some of the implied volatility, but we're kind of neutral on collecting the value of the option based on the stock price. We have another part of this option is time decay, and we don't see much in that right now either. Now to the option chain, when we look at the money, we see that it's negative $1.10 for the bid, and the ask is $7.15. So a little better than DRNA. This is only $8 spread, but way worse than Apple. Apple was 15 cents, and these are $8, $9 spreads. So that's why this morning DRNA was up 50% and wouldn't take you out of the trade because it's whipsawed because of the implied volatility, but we can see price hasn't done anything. And that's why right now on HCM, we're up almost 60%, but it hasn't taken us out of the trade yet because, again, price is just flat. And that's why I focus on only managing the winners using the GTC. We're going to need implied volatility to come down and price to come down a little bit more with the added bonus of time decay to allow the trade to work out. And it will work out. Because look, implied volatility here, even this whipsawing back and forth of implied volatility here, you can see that it kept losing its momentum and value going down as price went down and as time decay went in the future. That's the same thing we should see here. As implied volatility moves back and forth, it should be easing lower each time, along with price and time decay. Having all three things work together to make your profits. Sometimes implied volatility has huge spikes up and then immediate fall off, which that is the best case scenario for us. But just like patterns with candlesticks, implied volatility can also make patterns like wedge formations. Coming out of resistance, pull back to support, wedge formation, pennant pattern, or broadening pattern. All of these things tell us that price action is getting ready to move. Right here, we had a breakout. Right here, we had a sell-off. So what is this price pattern telling us on implied volatility? Hopefully, a breakdown. So put your good till cancel on it and just stay in the trade. Don't change your target. Don't chase the money. Let it come to you.